What if one of the most powerful voices in global finance is quietly warning that the system could crack, not because of inflation or debt, but because prices have soared too high, credit has grown too fast, and unseen risks are building beneath the surface? That voice belongs to Lisa D. Cook, a Federal Reserve governor whose recent warnings are sending ripples through markets and whispering a question into the world's most elite corridors. Are we sitting on a financial time bomb? Lisa Donnell Cook wasn't born in a boardroom, nor did she grow up surrounded by financiers. Her story begins in humble beginnings and intellectual rigor. Born in 1964, she would later earn a PhD in economics from UC Berkeley after a journey that included Spelman College, Oxford, and a deep academic engagement with economic history. Years before she joined the Fed, Cook built her reputation as a scholar, working on economic development, financial history, and the underlying forces that drive instability. She taught at Michigan State University, advised governments in Africa, and served on the U.S. Council of Economic Advisors. When President Biden appointed her to the Federal Reserve Board in 2022, she made history. She became the first Black woman ever to serve on the Federal Reserve's Board of Governors. Her perspective, shaped by academic rigor, economic history, and social awareness, would prove critical in her role as a guardian of financial stability. In November 2025, Cook stepped to the podium at Georgetown University's Business School. The room was filled with economists, students, and market watchers. But what she said wasn't typical central banking rhetoric. She warned of historically elevated prices, not just in stocks, but in corporate bonds, housing, and leveraged loans. She expressed a concern that many in finance dread: a significant drop in valuations. But here's the twist: she didn't predict a catastrophic crash. Instead, she leaned in. My impression is that there is an increased likelihood of outsized asset price declines. Yet, she added a qualification that separates her from doomsayers. She believes the financial system is resilient. According to her, the system today doesn't carry the same fragile architecture that precipitated the Great Recession. It was a nuanced warning, not panic, but urgency, not alarm, but caution. And it came from someone whose career has always emphasized balance, history, and structural risk. To understand why Cook's words matter, we need to dig into the vulnerabilities she highlighted. These aren't speculative. They stem from her long study, her role on the Fed's Financial Stability Council, and her academic work on systemic risk. First, asset valuations. Cook has repeatedly emphasized that elevated valuations, when paired with aggressive borrowing, are dangerous. In a prior speech, she explained that when investors stretch for yield and pay up for risk, the potential for outsized drops in prices becomes more real. Second, borrowing by businesses and households. She sees borrowing risks that could amplify instability if the system turns. Third, financial leverage and funding risks are central in her analysis. She warns that funding pressures could rise in a stress scenario, especially when certain parts of the financial system are highly leveraged. And there's another layer: that often goes unnoticed: liquidity risk in the Treasury markets. Cook pointed directly at hedge funds. These funds, she argues, have become deeply embedded in the $30 trillion U.S. Treasury market through leveraged trades, basis trades that exploit tiny price discrepancies between cash treasuries and futures. In calm markets, these trades add efficiency. But during episodes of stress, their unwinding could magnify instability. Cook warned that crowded hedge fund positions could spark liquidity spirals. Perhaps her most pointed concern was with private credit, a sector that has ballooned in recent years. Cook has repeatedly called for more scrutiny of this space, especially in structures like business development companies, or BDCs. Private credit, she argued, is not just growing, it's deeply intertwined with the broader financial system. While these funds have delivered high returns and very low default rates historically, Cook warned that those numbers could be misleading. She suggested that certain payment-in-kind agreements or non-standard covenants may hide real stresses. Her message: even though private credit may seem safe now, it's a core vulnerability, and if we ignore it, we could be blind to the next structural crack. In a layer of insight that surprised many, Cook didn't shy away from modern risk. She discussed algorithmic trading powered by AI. She gave a balanced assessment. On one hand, AI-driven trading could potentially stabilize markets by eliminating human herding behavior. On the other, it could amplify sudden moves. We are seeing early evidence for both, she said. The concern is not hypothetical. As trading becomes more machine-driven, the risk of sharp liquidity withdrawals or synchronized selling could grow. That, in her view, is not just a technological problem, it's a financial stability issue. To understand why Cook's voice carries weight, we must step back into history. In a notable 2023 speech at Duke University, she reflected on her childhood summers there and the legacy of her uncle, Samuel Dubois Pluck, a pioneer in Black academia. But she also spoke of her deep academic work, analyzing post-Soviet banking crises, fragile financial systems, and how under-regulated credit can destabilize economies. In another speech in Ireland, she reflected on global financial vulnerabilities, drawing parallels between different regulatory regimes, credit booms, and systemic risks. Her academic career is rooted in not just growth, but resilience. She did not come to the Fed to cheerlead. She came to watch, to warn, and to guard. Cook's warning isn't academic. It has real-world consequences. Imagine a world where equity valuations drop sharply, where corporate bond market liquidity dries up, where private credit funds under stress and hedge funds offload treasury positions violently. That could ripple across the global financial system. Banks could tighten lending, firms could go under, and investor confidence could evaporate. But Cook doesn't think we're there yet. She believes the system today can withstand shocks. Still, her message is urgent. We should not be complacent. Her view also raises moral and political questions. Should regulators do more? Can the Fed truly monitor and tame private credit? Do we need better frameworks for algorithmic trading? And what happens if markets reinterpret her warning as a signal for volatility? Cook's role is not just technical, it's deeply political. In 2015, she faced fierce backlash. Allegations arose over her mortgage history that she misrepresented primary residences on property documents. Former President Trump demanded her resignation. But Cook pushed back hard, defending her integrity and refusing to step down.
Through it all, she remained focused on her mandate: financial stability. Her warnings, she argued, should not be reduced to politics. They are rooted in decades of research, in a firm belief that central banking must guard not just inflation or growth, but the very scaffolding of the financial system. Cook's caution sets up a difficult choice for policymakers. Do they dial up regulation, especially on private credit and leveraged funds? Do they try to anticipate and mitigate liquidity risk in the Treasury market? Should they build new guardrails around AI-driven trading? For markets, her words could trigger repositioning. Some investors may pull risk. Others may ignore them, betting that valuations will continue to climb. For the Fed, the challenge is balancing caution without stifling economic growth. And for Cook herself, the stakes are personal. She must defend not only her views, but the Fed's independence, all while under political pressure. Lisa D. Cook's warnings are not alarmist. They are historically grounded, intellectually rigorous, and strategically urgent. She speaks of resilience, but also real risk. The risk that markets may be overvalued, credit too loose, and liquidity too dependent on leverage structures. Her legacy might be defined not by the crises she predicts, but by the ones she helps prevent. If the financial system weathers the next storm, historians may look back and credit her voice, not as a Cassandra, but as a sentinel. But if markets do falter, her warnings could become a defining call to action. That central banks must guard not only inflation and growth, but the architecture of finance itself. In a world obsessed with growth and innovation, Cook's message is a reminder: stability matters. And sometimes the most powerful thing a leader can do is warn. Lisa Cook didn't come to Washington to follow the script. She came to watch, to warn, and to protect. The question she leaves us with is simple but profound. How safe are our markets? And what are we willing to do to keep them that way?